Alrighty traders, welcome to the Compounding Growth Technique class. So I'm super excited to have y'all here, and I'm really looking forward to showing you how to simplify your approach to trading to the point where you can generate consistent results really without having to think. So I appreciate you being here, super excited to get jumping in and get started. And as far as the structure, there's four major things we're going to focus on. We're going to focus on the squeeze and a few different indicators and tools that we need to efficiently run this business. I'm going to talk a little bit about my favorite option strategy, which is the credit spread. So I found in my own experience, the credit spread is the most efficient strategy as far as creating consistent returns and hitting those monthly goals. And then what you're all here for ultimately is the checklist, which we're going to cover in part 3. And then in the final part there, part 4, I'm going to show you the day-to-day operations of running your efficient trading business off of these checklists. I'm going to run some scans. We're going to build a focus list. I'm going to take you through all the things that I do on a day-to-day basis, and it's all straightforward. And the beauty is, once you get into your rhythm, it might take 10 to 15 minutes out of your time. So let's get diving on in. But before we get started, my goal for the class is that y'all leave here with a clearly defined game plan and a system that can deliver the consistent results you're looking for. It's also my goal, additionally, to simplify your approach to the point where you're running your business off of these few simple checklists, okay? And ultimately, we want an approach to trading that doesn't just allow us to generate consistent results, but we want to do this without having to be glued to the screens, and more importantly, we want to be able to do this without being emotionally attached to our trades every day. And if we can do this, right, this way, we can enjoy our limited time here doing the things we love the most, while at the same time creating that financial consistency, or that financial freedom rather, that so many of us aspire to achieve. And when it comes to eliminating emotions from the trading process, you will never be able to perform at your best or generate the results you're looking for if you let your emotions play a role in the trading process. So we don't want to think, and we don't want an opinion. And I've been through this in my personal life. So quick story here. The first love of my life was a game of basketball. And that started around the age of 10 or 11 years old. I gave basketball everything I had. I worked so hard, I practiced so hard, and though I did become a pretty good basketball player, I was never able to live up to my potential. I was never able to fully, take advantage of the skill set that I had, acquired over the years through all the hard work, because I had a lack of control over the emotions. I wanted to play good too badly. I wanted every shot to go in. I had the skill set, but I can never control those emotions. I would walk out there on the court, and the emotions were always playing a role. That held me back from ever realizing my potential in the game of basketball. And when it comes to trading, if we can't eliminate those emotions, it can do very much the same thing. You can have a great knowledge of the market. You can have a good understanding of option strategies and what's a good setup, what's not a good setup. But ultimately, if the space between your ears is interfering, you're not going to be able to create consistency. So we want to eliminate emotions from this entire process. And another thing we really want to do is have a probabilistic mindset. When you as a trader can think in terms of probabilities, this removes a lot of the fears associated with trading, and not just in trading, but life outside of the market. So I used to have this crazy fear of airplanes, right? And it was never because of a negative experience on an airplane. It's just, for whatever reason, I didn't like airplanes, right? They freaked me out. The idea of flying would totally freaked me out. It was pretty serious, to the point where, even a plane flying above overhead would make me feel uncomfortable. The thought of going on a plane would make my hands all, clammy and sweaty. That was all in my head. Right? I never had a bad experience on a plane, and thinking in terms of probabilities, that's what allowed me to get over that fear, right? Walking down on the street, on the sidewalk, driving a car, probabilities-wise, that's way riskier than flying in an airplane, right? The probabilities just, they're right there on the table. The probabilities are, that's the safest, safest means of transportation. So, I've flown a little bit this year, and I've actually enjoyed being on the airplane. I find it pretty amazing, right? And I wasn't able to get over that fear until I developed that probabilistic mindset. So it helps you out in trading, but it really can help you out in life as a general statement, as it did for me there. When everything we're going to focus on here ties together. We use the checklist, we focus on the things we focus on, we ignore the things we choose to ignore, because ultimately we just want to create consistency. And it's the consistency in those steady gains that can harness the power of financial compounding over the course of time. So a monthly goal of, say, 10%, that's not only achievable, it also leads to some serious big-time account growth over the course of just a few years. So check this out, right? 2.5% a week, that's about a 10% return on the monthly basis. With this checklist, these are very achievable numbers. If you could start an account with $10,000 and you could just simply grow that account by 2.5% per week, at the end of year one, that $10,000 is compounded into $34,371. That's a phenomenal return, but the consistency here is that you do that year after year after year after year after year. Check this out. At the end of year 5, your $10,000, after for 5 years straight, growing it at 2.5% a week, would compound into $4.8 million. Absolutely insane. So, this is just a spreadsheet, right? These are just numbers. However, this should show you at least a glimpse of what is possible. And then your goal should be to approach the trading in a fashion where you're getting your piece of this action. 2%, 2.5% a week is achievable. 10% a week is achievable. But I mean, hey, even if we can get just a fraction of this, there's some unreal potential here. So that's how everything ties together. We're going to utilize our checklist not to look for home runs, but to look for those consistent singles and doubles week after week. That's what can take advantage of that power of financial compounding. So that's the ultimate goal. And we want to do all this while we enjoy the process. Plain and simple, because I've been there. I'm sure so many of you tuning in here have been there. Stressing over trades isn't fun. What is fun, though, is running an efficient trading business. That can be very enjoyable and a very fulfilling process. So, yeah, we want the financial rewards, but we also want to enjoy the process while we're at it. So here's an outline for the class. 4 different components. We're going to talk about the squeeze, the different indicators, our tools. We're going to cover the option strategies, being the credit spreads. Then we're going to jump into the checklist, and then we're going to go through the day-to-day practices of running this business here. So without further ado, let's go on ahead and let's jump into part 1. All right, my friends, part 1. Let's go on ahead and dive in here. So we're going to talk about the squeeze at a few different points here throughout the class. And some things are repetitive for a very good reason. The squeeze is so incredibly important. You just need to understand the nuances and, how to make the setup work in your favor. So, quick background with my love affair with the squeeze. Back in 2017, I traded my first squeeze. It was a daily squeeze in the financial sector, XLF, and here's the squeeze. And I pretty much bought calls on every financial stock imaginable for diversification's sake, and the rest is history. So ultimately, that daily squeeze fired to the upside. It was my biggest, handful of profits I had ever made, and I was immediately hooked to the setup here known as the squeeze. And the power of the squeeze, it's going to help us identify that moment in time when a stock is gearing up to make a meaningful move. Truth of the matter is, a good 70-80% of the time, stocks aren't moving in a meaningful fashion. They're not making a meaningful move. They're just kind of blindly, endlessly chopping back and forth. So when there's a squeeze, and only when there's a squeeze, then we have found that moment in time when the stock is preparing for a potentially meaningful move. Now, in terms of what is a meaningful move here, one of the tools I like to rely on are the Keltner channels. And what I do here with these Keltner channels, you can see I have 3 different sets here. Got my red, my purple, and my yellow. The Keltner channels are going to measure average true range from the 21 period EMA. So ATR, average true range, is the average move a stock has been making over the last 14 or so days up and down. So on my charts, 3 different sets of Keltner channels, and the yellow ones, they measure one average true range move above and below the 21 EMA. The purple Keltner channels here, those measure 2 and -2 average true range moves from the 21 EMA. And then the third set of Keltner channels, the red set, that measures 3 and -3 average true range moves above or below the 21 EMA. So for those of you who have Thinkorswim, to set your Keltner channels up, you're going to want to do this 3 times, one for each of the 3 different sets. So here's the settings I have on Thinkorswim: displace of 0, factor of 1, and then a length of 20. The only tweak you want to make here to how Thinkorswim does this by default, change the average type to exponential. Keep true range type to average, change the average type to exponential. And that's all you got to do. You want to do this once with a factor of 1. That's measuring one average true range move. You want to do this again here with 2 for a factor, and then again with a factor of 3. Just do that 3 times, save those on your charts. Now you're going to have your 3 different sets of Keltner channels. Now, in addition to the Keltner channels there, again, what are those measuring? They're measuring average true range moves above and below the 21 EMA, the 21 period exponential moving average. This serves as our mean, right? It's the average price, it's home base for a stock. All that stocks do, and this is just the ebbs and flows of the market, all that stocks do is move away or back to the 21 EMA. And more often than not, most of the big moves tend to start at the 21 EMA. And one golden rule to understand as a trader, stocks in the market always come back to the mean. They always come back down, or they always go back up to the mean, to the 21 EMA. And again, this is just the ebbs and flows here of the market. So without any other tool here on this weekly chart for the QQQ, this is the ebbs and flows of a weekly chart. We make a big significant push off of the 21 EMA, but what do? We come back home. We revert back to the mean. Again, another move to the upside, and what do? We pull back to the 21. Another big move to the upside, another dip to, you guessed it, the mean, another big push, another reversion to the mean. That's the ebbs and flows of the market in an uptrend. Whether it's a daily chart or a weekly chart, it's a series of moves away from the 21 and back to the 21. Away from the 21, back to the 21. Over and over and over again. That's how the market works. So stocks always come home. Look at GameStop here. Right? One of the bigger, call it meme stocks of the year. This just explodes. And this goes crazy. This goes from $160 a share all the way up to $320. So this thing goes up 100% in a few days. However, what did it do? Even a meme stock, even a crazy short covering rally comes back home to the 21. Stocks always come back home. So very straightforward for the 21 EMA settings on Thinkorswim. There you have it. Right? Length of 21. It's an exponential moving average. Very straightforward. And you can fancy it up with the color of your preference there. Now, when it comes to the squeeze, these powerful moves, they start at the 21 EMA. So when a squeeze forms as a stock is near that 21, there's an increasingly growing probability of a bigger than average move just around the corner. Now keep in mind, we're only going to take that setup if it fits the rest of our checklist. So a daily squeeze at the 21 EMA, it is a good start. We need a little bit more edge though. That's where the few tools we like to focus on and the indicators, that's where they really come into handy here. Now you hear me keep referring to an average move. So what do I even mean by an average move? Well, an average move is a move between +1 and -1 ATR, right? The average true range. The average move for a stock, 1 ATR to the upside, 1 ATR to the downside. That's just the average. It's choppiness, it's noise, and the squeeze. The squeeze is designed to identify that moment in time, and we are consolidating to a point that everything has contracted. We are in such a tight, narrow range. All we're doing is trading between +1 and -1. That's the buildup of energy. That's an important consolidation. So that's an average move. 1 ATR above the 21, back down to it. 1 ATR under the 21, back up to it. That's the average right there. Looks pretty choppy. Now, what's a bigger than average move? A bigger than average move, or what I like to call a meaningful move, is a move 2 to 3 average true range moves above or below the 21 EMA. And this is the importance of the Keltner channels. If you look at GameStop here, let's start to tie it together. You got a daily squeeze. The squeeze takes place at the 21, and After we fired the squeeze, we got a bigger than average move. Very quickly, after weeks of average price action, +1 ATR, -1, +1, -1, +1, -1. Once that squeeze fires and releases all the energy we're building up here, there's a meaningful move. A bigger than expected move is a move into 2 to 3 plus ATR. The squeeze, that's what helps us find this. That's that moment in time, and that's the move we're looking to catch over and over and over and over and over and over and over again. And you can build a trading career around this one setup, especially when it meets all of our criteria. That's what I've done. It's built a career around this kind of setup. So it's that moment in time when all we're doing is making an average move, but we've consolidated to the point, everything has contracted, we're building up energy. Once the squeeze fires, there's your bigger than average move. +1, -1, average. 2 to 3 ATR, up or down, bigger than average. So the 21 EMA and the Keltner channels, that's what ties everything together here. So put it all together. We find a squeeze that fits our criteria. We build our positions near the 21 EMA. So when the stock is near the 21 and it's trading between that +1 and -1 average true range Keltner channel extension, that's what we identify as our buy zone. So we find a squeeze, we're going to run it through our checklist. If it fits our criteria, we take an entry here at the 21 and we take profits on the bigger than expected move. We take profits on the move into 2 to 3 plus ATR. Every single time. That's what we rinse and repeat. So here's a case study. Good looking trade here on NVIDIA, and let's run it through a bit of the few different components here. So we got our Keltner channels, we have a daily squeeze, we have positively stacked EMAs, and we're not chasing this. It's right in the buy zone. It's right near its 21. It's right between +1, -1 ATR. Because it meets our criteria, that's where we take our entry. And where do we take profits? On the bigger than average move. We take profits as we push through 2 to 3 plus ATR. So for NVIDIA here, I took my position in the squeeze at the entry zone. I sold the put credit spread with short strikes here at 520. And then as the squeeze fired, I bought back that spread for a nice $6,300 profit. So I sold the spread at just about $1.70, and I'm buying it back a few weeks later here at 40 cents. Really good return on that trade. And it's simple. It's straightforward. It doesn't require active management. You run the scans, which we're going to do later. You find these kinds of clean setups. You put them on your focus list. You take an entry at the buy zone. You take an exit at 2 to 3 ATR. Can y'all see yourself just doing this for a living? It can be that simple. And the nuances, that's what we're here to discuss today. Let's run Tesla here through the ringer. So we have our daily squeeze. We can see with our 21 EMA and our Keltner channels, we're right at the buy zone. Hey, this fits the bill. Perfect. So on this Tesla trade on April 6th, I sold a put credit spread with short strikes at 650. And a couple of days later, squeeze fires. What do we do? We moved from the 21 about 2 plus ATR to the upside. That's the move I'm looking for. So I sold that spread at $1.67, and then as it hit the target here, I'm buying it back for 24 cents. So that was good for a $5,000 profit. Why do we follow that rule though? Remember, probabilistic mindset. There's a growing probability of a move into 2 to 3 plus ATR once we find a squeeze with our structure intact. Once we find a squeeze that fits our criteria. However, once we've made a move into 2 or 3 plus ATR, now there's a growing probability that what are we going to do? Come back down to the 21. Reversion to the mean. That's why we take profits here, okay? Now, these tools and this checklist and this structure, we can take this to any time frame. So a weekly squeeze here on Amazon, when we found the weekly squeeze, it's at the buy zone, right, between +1 and -1, at the 21, stacked EMAs. That's all I'm looking for. So for Amazon here, sold my put credit spreads. As long as we hold structure, which we'll talk about here in a bit, you hold on to that position. You know, a squeeze isn't going against you until we're closing under -1. Did Amazon ever close under that -1 ATR? No. So I got to hold on to that trade. The squeeze is literally designed to find these moments in time when all we're doing is +1, -1. That's not going to shake me out. And then a few weeks later, we didn't quite get the +2 ATR, but it was a good enough move to buy back those spreads there for $23,000. I'm sorry, for $13,000 of profit between the three or four of them here. So we can take this checklist, we can utilize these tools, the 21 EMA, the Keltner channels, on a weekly chart, a monthly chart, even all the way down to a 30-minute chart like this trade. You find a 30-minute squeeze, you look for stacked EMAs. Are we near the buy zone? Well, yes we are. Even though it's a 30-minute chart, it has the same high probability structure. So in that 30-minute squeeze, we sell the put credit spread, and as that squeeze makes a bigger than expected move on the 30-minute time frame, of course, we're taking profits into that momentum. So call this a continuation trade. Sold a couple different put credit spreads at 356 and 384, and I'm buying them back a few days later for some pretty modest profits. So $6,134 of return, 25% return on risk. I'll take it. As long as it fits the structure, we can make this work on a 15-minute chart all the way up to a monthly chart. It just has to fit the structure of our checklist, and the tools that we depend on here. It not only helps us identify the moment in time where we're getting ready for a meaningful move, it helps us dictate where should we take entries and exits. So, good example there. Now, how about short setups? Just as simple. Slightly different checklist, which we'll get into here in a bit later. Slightly different checklist, same exact tools. We're going to utilize that checklist, and we are going to short at the buy zone under the 21 EMA. And where do we take profits? At the -2 to -3 ATR extension. It's the ebbs and flows. Now the structure here, and that's what the checklist is for. The checklist helps us focus on structure. When the structure fits all the requirement of our bearish checklist, we're following the same ebbs and flows. We're going to short this buildup of energy in the buy zone as close to the 21 EMA as possible, and then as we move on to the release of energy, we're going to cover our shorts and take profits at -2 to -3 ATR. Why? Because now there's a growing probability that Tesla bounces back to the 21. So we want to take those profits. So on this trade here, because it fit the criteria of a good short, I sold a call credit spread near the 21 EMA at $2.23, and a couple sessions later, I'm buying it back at 55 cents. A nice, short and sweet $1,700 profit. So shorting is just as easy as going long. If the checklist says it's a long position, well, we build a position in the buy zone near the 21, and we just take profits at the 2 to 3 ATR extensions. And we don't question this. We don't think. We don't have an opinion of what the stock could do next. This is what we rinse and repeat, because we can do this over and over again. It's consistency, but also, just as importantly, it's frequency. And for a short setup, as long as it fits the criteria of our short watch list, we're going to build our short position in the zone near the 21 EMA, and we're taking profits at the -2 to -3 ATR extensions. Now, in terms of risk management here, utilizing the Keltner channels, we only look to close our trades on these kinds of setups when there's a loss of structure. And what I mean by a loss of structure is that we have closed below, if you're long, a close below, or if you're short, a close above the 1 ATR extension. A good strong squeeze should not close below -1 ATR. So we'll look at an example here. But before we do, look at these other trade examples. Google. You didn't get closes under -1 ATR. That's a hold of structure. That is what the daily squeeze is designed to find. We find that moment in time, we plant our position, and we hold on until one of two things happens. Either the squeeze fires in our favor and we get to take profits at the extension, or we get a close under -1. That's a loss of structure. Just like BLNK here. When I took this entry, picture perfect. Daily squeeze, an entry near the buy zone. You had stacked EMAs. However, check out the loss of structure. You start to close down under -1. No more stacked EMAs. That's not what should happen with a bullish daily squeeze. Now, we don't want to have an opinion that BLNK could recover here and it can go back to highs. No. We're going to follow the rules. Once we get a close under -1 ATR, No questions asked. We're cutting off that trade because it's a loss of structure. So a good example of this here is LEN. When I took the trade, everything fit my requirements. Had a squeeze, we had stacked EMAs, we're here at the buy zone. So I took the position. Now notice something interesting here. We very quickly hit +2 ATR, and I made a mistake and did not take profits. Look what happened. Following days, we lose structure. I had to exit the trade for a loss. Once we lose the stacked EMAs, once we are under -1 ATR, it's not what a good-looking daily squeeze should do. No opinions or emotions involved. It's not what it should do. So once you close under -1, I cut those trades off. So I sold the put credit spread here, and then I had to buy it back for a $8,000 loss because it was a loss of structure. I'm sorry, for a $3,500 loss, not as bad. But once you lose structure, that's the rule. A close under -1 ATR, we're going to exit on long position. If we're shorting something, a close above +1 ATR, we got to take the position off the table there. Now here's an example of another winning trade, and this is an important one. Great structure, squeeze, entry at the buy zone, stacked EMAs. Notice here, I took profits as I should. I planted my seed the next morning. There's the move I'm looking for. From the 21 EMA into 2+ ATR. So I did what I should do here. I followed my rules, and I took the $3,400 of profits off the table, and look what I avoided. In the days that ensued, all BLNK does here is pull back to the 21. Now, regardless of where it went from there, that's a headache I don't have time for. I make a living building a position in a squeeze and taking profits at 2 to 3 ATR. I don't have concerns about what happens next. This is a good example. Sometimes it continues to run, but I don't have time for that. I want to find the high probability setup. I want to get my piece of the move, and then I want to keep the bus moving onto the next good setup. So let's keep going here. Quick recap, okay? Why the squeeze? The squeeze helps us identify that moment in time when a stock is preparing for a bigger than average move, which is 2 to 3+ ATR off the 21 EMA. When we find a squeeze that meets all of our criteria, there's a 70-75% chance in my experience of that squeeze firing to the upside. So we build positions near the 21 EMA, we take profits at the 2 to 3 ATR extensions, we hold on to positions as long as they're holding on to structure, and we take losses when there is a loss of structure. And one thing just to always remember, stocks always come back to the 21. You might take profits at 3 ATR, the stock might rally for another 2, 3, 4, 5, 10 days. It doesn't matter. You caught your piece of the move, and it's always going to come on back home to the 21, offering another opportunity for a better entry. You know, the quality of the entry just starts to disintegrate the further and further we get away from the 21 EMA. So really simple stuff. The squeeze is incredibly powerful, but with a few of these different tools here, we can use them to our advantage. We can not only identify that moment in time when here comes a potentially awesome, powerful, big-time meaningful move, but we use the Keltner channels to help us determine where's the most intelligent and highest probability spot to take our exits. Simple stuff, and that's it for here on part 1. So let's get moving on to part 2.